Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session in which we are going to discuss a very important report of the Reserve Bank of India, that is the Financial Stability Report. Okay, so good morning everyone, good morning Saurish, Aditi, Nitya, Manish, Neil, good morning everyone and welcome to the session. Welcome to this important session where we are going to discuss the Financial Stability Report of the RBI, which is one of the most important reports of the RBI. Okay, and this is recently released on 30th December 2024. So this is an important edition that we have to discuss, and there are some changes that the RBI has done in the testing. So we will discuss that how the changes or what the changes are. Okay, so let's discuss the Financial Stability Report and give me a thumbs up if I'm clearly audible and visible. And I hope you know the importance of the Financial Stability Report. This is one of the most important reports of the RBI, from where descriptive and objective questions can be asked by the exam conducting authority in the RBI Grade B exam. Okay, so now before starting with the session, do subscribe to the YouTube channel of EduTap and join our Telegram channel. In the Telegram channel, you will get the PDF of the session. So the PDF of the session you will get in the Telegram channel, and the link for the Telegram channel is provided in the description box below. Okay, so thank you for the confirmation. Let's start with today's session. So first of all, Financial Stability Report. It is a half-yearly publication. It is a half-yearly publication. So the recent report is released in December 2024, and the next edition will be released in the coming July, okay, or June or July. So the Financial Stability Report is a half-yearly publication, and the RBI has recently released the December 2024 issue of the Financial Stability Report. Now this report is prepared, or this report presents the collective assessment of the subcommittee of the FSDC. So this report, it presents the collective assessment that is done by the subcommittee of the Financial Stability and Development Council. So the Financial Stability Report, it is a half-yearly report, and the RBI has released the recent issue. So now this report, it provides or it presents the collective assessment done by the subcommittee of the FSDC. So first of all, what is this FSDC and what is the subcommittee of the FSDC? So FSDC, that is the Financial Stability and Development Council, has been constituted through the Government of India notification dated 30th December 2010. The council is chaired by Union Finance Minister. So the Finance Minister is the chairman of this committee, that is the FSDC. Okay, so the chairman of the council is the Union Finance Minister, and the members are the Governor of the Reserve Bank of India, Chairman of SEBI, Chairman of IRDI, Chairman of PFRDA. So you can understand that all the regulators are also the member of the FSDC, as well as the Finance Secretary and or the Secretary of the Department of Economic Affairs, the Secretary of the Department of Financial Services, the Chief Economic Advisor of the Ministry of Finance. They are also the member of the FSDC. So all the big regulators, all the big heads in the country that are connected with the financial stability, that are connected with the financial domains, they all are the members of the FSDC. Now there is a subcommittee of FSDC. There is a subcommittee of FSDC. So this subcommittee of FSDC has been set up under the chairmanship of Governor of the Reserve Bank of India. So the subcommittee of FSDC, the chairman of the subcommittee is the Governor of the Reserve Bank of India, and all the members of the FSDC are also the member of the subcommittee. Okay, so this subcommittee meets more often than the full council. All the members of the FSDC are also the member of the subcommittee. So that is the chairman of SEBI, the chairman of PFRDA, the chairman of IRDI, as well as the other important heads are also the member of the subcommittee. Additionally, all the 4 deputy governors of the Reserve Bank of India and the additional secretary of the Department of Economic Affairs, who is in charge of FSDC, are also the members of subcommittee. So the important people are the member of subcommittee, and this report, that is the Financial Stability Report, the recent edition, this is prepared with the collective assessment, and this report of the Reserve Bank of India, that is the Financial Stability Report. This Financial Stability Report is prepared by the Reserve Bank of India, and this report reflects the collective assessment of the subcommittee of the Financial Stability and Development Council, that is the regulators of in the different domains, the SEBI, IRDI, PFRDA, the economic advisors and such, they all have given some assessment for the FSR, okay, or they have helped in the preparation of the FSR by giving some assessment. So this FSR, it reflects the collective assessment of the subcommittee of the Financial Stability and Development Council on the resilience of the Indian financial system and the risk that are associated with the financial stability or the risk to the financial stability. So this is the idea. FSR is a half-yearly publication and it is the collective assessment of the subcommittee of FSDC. Now the FSR, the Financial Stability Report, is prepared under the 3 chapters. First of all, macro financial risk. What are the risks at the global level and domestic level? Financial institutions, soundness and resilience. So in this we discuss the instruments like CRAR, profitability, and the different variables we discuss. Okay, that what is the CRAR, what is the liquidity coverage ratio, what is the provision coverage ratio. So these tools or these variables are discussed under the soundness and resilience to see the soundness and resilience of the financial institutions, the soundness and resilience of the banks, NBFCs and such. Okay. Next is regulatory initiative in the financial sector. So in the past 6 months, whatever the initiatives that have been taken by the different regulators, so this is discussed under the regulatory initiative in the financial sector. So this is the brief about the FSR. Shall we start with the first point of the FSR? Shall we start that what the FSR is stating? Till now, any confusion anyone has? Any confusion anyone? Are you clear about the basic idea of FSR? Now we are going to start with the report. What the report is stating, what the report has said. Okay. So the global economy and the financial system remain resilient around the globe despite the heightened uncertainty. Okay. So there is uncertainty that is present because of the geopolitical situation, because of the problems that are going on between the countries. So there is uncertainty that is present. Okay. There is uncertainty that is present, but still there is resilience in the global economy and the financial system. There is normalization of monetary policy that is underway. So normalization is happening of the monetary policy. So because of the Russia-Ukraine war, because of the COVID-19, there was inflation that was rising around the world. The inflation was increasing around the world. Now to control this inflation, what was done by the different reserve banks? So RBI and the other monetary authorities all over the world, they started increasing their rates so that in the country the interest rates increase. So if the Reserve Bank of India is increasing its repo rate, if the Federal Reserve of New York, that is the monetary authority in US, if it is increasing its Fed rate, so interest rates start increasing in the economy, in their particular economy. So if interest rate is increasing, less loans will be taken. At the higher interest rate, you will not want to take so much of the loan because you will have to pay higher interest rate. So at the higher interest rate, less loans are taken. So less loan means less money supply, less demand in the economy, and the prices will start decreasing. So the monetary authorities around the world, they were increasing their rates so that they were increasing the interest rate in their economy to control the demand, to control the prices in the economy, to control this inflation that was increasing very, very fast because of the Russia-Ukraine war, because of the supply chain disruption. Okay. So now what is happening, that as the inflation is decreasing, that is disinflation, inflation rate is decreasing, that means disinflation is coming into the economies. So the monetary authorities have decided to normalize their monetary policy. Recently there was news that the US has started and decided to decrease the rates. Okay, so normalization is coming in the monetary policy that is underway. Financial conditions remain accommodative, that is accommodative policy is being followed, and the financial conditions are also becoming better. Now with this, what is happening, that while the near-term risk has decreased, but there is still some vulnerability that is present in the global economy. So there are some problems that are still present in the global economy and among the countries. So that is, first of all, stressed asset valuation. That is, the assets are getting overvalued. There is overvaluation of the assets that is happening, the stocks, bonds and the real estate also is getting overvalued in many of the countries, and that is a very big problem because the US financial crisis of 2007-2008 started because of the overvaluation of the real estate. So if we see the US financial crisis that started in 2007-2008, this was because of the overvaluation that was done in the real estate, or too much of the valuation was increasing of the real estate. Now there is again the problem of the stressed asset valuation. That means there is overvaluation that is happening of certain assets. So that is a problem, that is a vulnerability that can affect the economy in the long term, that can affect the global economy. Okay, next is high public debt. So the public debt is increasing, and debt always lead to problem if the capacity is not developed in the countries. Okay, prolonged geopolitical conflicts among the countries. Day after day we are hearing some new problem that is arising, some new conflict that is arising. Russia-Ukraine war, then the Gaza situation started. So there is again and again some problems that are arising between the countries. Now there is another risk that is coming from the emerging technologies such as AI, ML. So we have discussed that RBI has recently made a committee so that we can use the AI, ML in the ethical and responsible manner, and the RBI itself is recognizing that there are some risk attached with these technologies. So that is also recognized under the FSR, under the Financial Stability Report, that at the global level there are the risk that is attached with these emerging technologies. They pose threat to the financial stability in the medium term. Okay. So now the IMF and World Bank, they have given their global growth projection. So as per the IMF, the forecast has been done. So International Monetary Fund has done the forecast that in 2024 the global economy is going to grow by 3.2%, and in the 2025 also it is forecasted that the global economy is going to grow by 3.2%. Okay, now the World Bank has forecasted, as per the data available, the World Bank has forecasted that the global economy is going to grow by 2.6% in 2024 and 2.7% in the 2025. So these are the global growth forecast or the global growth projections that have been given by the IMF and World Bank. IMF is expecting the global economy to grow by 3.2% in 2025, and the World Bank is expecting the global economy to grow by 2.7% in the 2025. Okay, so this is the idea. Now coming to the domestic economy. In the domestic economy, is very resilient. How many of you remember the report on trend and progress? You remember, have you seen that video, the report on trend and progress? Have you seen that? Okay, so in the report on trend and progress, the data we have seen for 2023, 24 and the data we have seen. So the data we have seen for the March end 2024 and the data we have seen for September 2024. So as per the data, the bank's position, is it good or not? The bank's position, is it good or not? The bank's position is very good, right? The bank's position is very good. The capital, they have good capital, they have good profitability, they have good like asset quality. The non-performing assets are decreasing. So as per the report on trend and progress, we have seen that the resilience is very high among the banking structure. So this FSR is saying the same thing. The Financial Stability Report is also saying the same thing. Okay. So if you have not seen the report on trend and progress, I will suggest you that do see the report on trend and progress, the previous session that I have taken, previous to previous. Okay. So the Indian economy is exhibiting steady growth. So growth is happening in the Indian economy, and we are having the steady growth underpinned by solid macroeconomic fundamentals. The macroeconomic fundamentals that we have are also very strong, as the financial system of our country is very resilient. It is demonstrating resilience that is supported by healthy balance sheet of the banks. The consolidated or the combined balance sheet of the scheduled commercial bank is expanding. The capital, they are holding more, so they are holding more capital to handle the distress. The banks are also having more profitability. The banks are also having more asset quality. So you can understand that their capital buffers are increasing, they have robust, good earnings and improving asset quality. So this is showing the resilience of the financial system of our country. So we have strong macroeconomic fundamentals that is helping us in the steady growth. Okay, so this is the idea. Now in the uncertain global situation, because the global environment is quite uncertain. Okay, so the global environment or the global macroeconomic condition is quite uncertain and there is uncertain financial environment. But with that, the Indian economy is exhibiting resilience and stability. Not a single bank of our country has fallen down in the previous 2-4 years, or not a single bank has shown immense distress in our country. And even if there is any problem that is coming up, the RBI is handling it very well. So you can understand that the Indian financial system is quite resilient and stable also. So the real GDP is projected to grow at 6.6% in 2024-25. So this is the projection that has been given by RBI, that in the 2024-25 we are expecting the real GDP to grow by 6.6%. Okay, so this is because of the revival in the rural consumption. So the consumption in the rural areas has started to revive, has started to increase. There is pickup in the government consumption and the government investment is increasing, as well as there is strong services export that we are doing. So we are exporting more and more services through which we are earning the foreign exchange, foreign currency. Okay, now the monetary authority, that is the Reserve Bank of India, is focusing on the monetary policy on a durable alignment of inflation, because when the inflation targets are being met, that is inflation target is 4% plus minus 2%. So if we are under this target, if we are following the inflation target, so the growth becomes more stable. Okay, so the growth becomes more stable. So the growth momentum remains strong and is supported by the monetary policy that is focusing on controlling the inflation and maintaining the inflation around the target. Okay, so this is the idea. Now there are some problems in the Indian economy also in the form of stressed equity valuations. Now the shares, recently the SEBI chairperson also said that the mid cap and the small cap companies are overvalued, or they are getting overvaluation. Okay, so you can understand that even the SEBI chairperson is recognizing that some of the equity, some of the shares, especially the shares of the mid cap companies and the small cap companies, they are getting overvalued. So there is some problem in the financial market of our country because of the stressed equity valuation, because of the higher or overvaluation of the small cap and mid cap shares. Pocket of stress in the microfinance. Microfinance means, see, we provide small finance or small loans are provided. Now how many institutions or which institutions provide microfinance? Anyone remembers? So there is one NBFC, microfinance institution, right? So there is a category of NBFC, that is microfinance institution, that provide the small loans, that provide the microfinance. Other than that, there is a specialized banking system. What is the name of those banks that provide the microfinance? Which banks provide the microfinance? So it is small finance banks. The small finance banks also provide the microfinance, the small finance, right? So there is stress that is coming in the microfinance. The microfinance sector is slowing down, and there are some sign of the stress also with rising delinquencies. That is, the many of the loans that were given are not coming back. Many of the people, they are not returning the money that they have borrowed across all types of lenders and ticket sizes, that is loan sizes. So in the multiple loan sizes, the multiple borrowers, they are not able to return the loan, or they are not returning the loan. So there is stress that is coming in the microfinance across all type of lenders also. So small finance bank, the microfinance institutions, they all are facing some stress because of the delinquencies in returning the loan. Okay, so consumer credit segment and the risk from external spillovers require close monitoring. So there are problems that are coming up in the microfinance area, or in the microfinance there is stress that is coming up. So, and the consumer credit also, in the consumer credit there is stress that is coming up. So that has to be looked closely. Okay, so now coming to the next part. Okay, someone asked me a question. See, AE, this is the advanced economies. EMDs are the emerging market developing economies. Okay, so AE is the advanced economies and the EMED is the emerging market developing economies. Okay, so that is the full form. Okay, next. Now coming to the banking sector soundness indicators. Now, what is the CRAR? What is the LCR? All of this we are going to discuss now. So kindly hear me clearly. So first of all, gross advances. The advances given by the banks have increased. You can see that from the 161.1, it has increased to 167.8. So the gross advances in lakh crores have increased from 161.1 lakh crores to 167.8 lakh crore rupees. Okay, so the gross advances or the loans have increased in September 2024. Now, gross NPA percentage. So the gross NPA, the non-performing asset. NPA is what? NPA is non-performing asset. So the banks are giving loan. Now this loan is the asset for the bank, because on the loan the bank is earning the interest. Now let's say that the borrower that has taken the loan is not returning the loan, is not paying the interest payments. So this asset, this loan becomes non-performing for the bank, as the loan is not getting returned, or the EMIs are not getting paid, or the interest is not being paid to the bank. So this asset or the loan has become non-performing as the borrower is not making the payments. So non-performing asset has decreased. That you can see that in September 2024, the NPA, the gross NPA decreased to 2.6%. Non-performing asset have decreased. Now 2.6%. This data we have seen in the report on trend and progress of banking in India. This report was released on 26th December 2024. So recently this report is released, and in this report also the data is given for September 2024. Now the idea is that the data given in report on trend and progress will be different from this data. Why? Because in the report on trend and progress we are taking the scheduled commercial banks, the data of the scheduled commercial bank, but here we are taking the data of the scheduled commercial bank excluding the small finance bank. Okay, so the data we are taking is of the scheduled commercial bank excluding the small finance bank. So scheduled commercial bank consists of the public sector banks, private sector banks, and your foreign banks. These are the three major head under the scheduled commercial bank, but the scheduled commercial bank also consists of small finance bank and such. Okay, so this is a very small finance bank are a very small chunk in the scheduled commercial bank, but here under the financial stability report, under the scheduled commercial bank we are excluding the small finance bank. Okay, so on the data of the report on trend and progress is different from the data of the FSR, because the report on trend in progress was not excluding small finance bank, but here in the FSR we are excluding the small finance bank. So there is going to be a minor change in the data, very minor, okay, 0.1% and such. So here you can see that the gross non-performing asset of the scheduled commercial bank excluding small finance bank has decreased from 2.8% to 2.6% at the end of September 2024. The net NPA. Now, what is net NPA? Anyone has any idea regarding the net NPA? So, net NPA is your gross NPAs. They are the total NPAs that the bank has, the total non-performing asset that the bank has, minus the provision that the bank is keeping against the gross non-performing asset. So, bank is keeping some provisions, some safety net against the non-performing asset. So from the gross, from the total non-performing asset, from the total loans that are not being recovered, from the total non-performing asset, deduct the provisions that the bank are keeping to handle such kind of stress, then you will get to the net NPA. So net NPA is 0.6%. The net NPA is 0.6% at the end of September 2024. Now coming to the return on asset percentage. So return on asset has increased. Yes. So return on asset has increased for banks. So return on asset shows the profitability of the bank. The return on asset has increased. The returns of the bank has increased from 1.3% to 1.4%. Okay. Now CRAR. How many of you know about CRAR? What is the formula of CRAR? So CRAR is the capital to risk weighted asset ratio. Okay, so the bank asset are the loans. So bank are giving the loans. Now the loans have some risk weight attached. Loan has some risk weight attached. So the risk weighted asset means that loans have some risk weight. Maybe 10% is the risk or 20% is the risk. So different loans have different risk attached. Okay. So according to the risk weighted asset, the bank has to keep some capital with itself. The bank has to keep some capital with itself. So the minimum capital that the bank has to keep against its risk weighted asset as per RBI is 9%. So 9% is the capital to risk weighted asset ratio that the banks have to keep with itself. So if the risk weighted asset is 100 rupees, the bank has to keep 9 rupees as capital with itself. Okay. Now plus 2.5%, this is the buffer. This is the buffer. This is known as capital conservation buffer. So plus 2.5%, that means 11.5%, 11.5%, that is out of 100 rupees, 11.5 the bank should be keeping with itself. Okay. So CRAR is the capital to risk weighted asset ratio. The CRAR is the capital to risk weighted asset ratio against the risk weighted asset of the bank. The bank has to keep some capital. So that is 9% of capital the bank has to keep. But additionally 2.5% of buffers also the bank has to keep. So in total the bank has to keep 11.5% of the CRAR. Okay, but here you can see that the scheduled commercial bank excluding the small finance bank are keeping the CRAR of 16.7%. That means against their risk weighted asset, the banks are keeping higher capital to handle the distress, and the higher capital the banks maintain, the higher capacity they have to handle the stress in the risk weighted asset. That if the asset is not returned, so if there is any stress that is coming in the banks, so that can be handled by the capital, okay, that the banks are holding with themselves. So against the minimum requirement of 9% of the CRAR plus 2.5% of the CCB, capital conservation buffer. So in total the requirement is 11.5% of CRAR. But the banks, scheduled commercial bank excluding small finance bank, are holding 16.7% of the CRAR to handle the distress situation as on September 2024. Okay, so this is the idea that scheduled commercial bank excluding the small finance bank are holding 16.7% of the CRAR at the end of September 2024. So that is a very good percentage and it is higher than the minimum requirement. Okay, so this is the idea. Now CRAR of all the SCBs including the small finance bank for September 2024 stands at 16.8%. So this is as per given in the report on trend and progress. So here you can see that this data is for the scheduled commercial bank excluding the small finance bank, but in the report on trend and progress they have included the small finance banks in the scheduled commercial bank. So SCBs including small finance bank, for them the CRAR is 16.8% for September 2024. Okay, so this is the idea. I hope it is clear. Now in the CRAR of 9% plus 2.5% is the capital conservation buffer. So in the 9% CRAR, that is the capital, the bank has to maintain the capital of 9%. Okay. Now this capital is in the tier 1 capital. Tier 1 capital is the most liquid capital or the liquid capital that the bank is holding. Tier 2 capital is the capital that the bank is holding that is not very liquid. Okay. So tier 1 capital is the liquid capital, and the tier 2 capital is not so liquid capital. So tier 1 capital is divided into the common equity tier 1, that is considered the most liquid capital that the bank can have, and the tier 1 capital also includes 81 bonds. Okay, tier 2 capital is usually not so liquid capital. Now out of this 9%, 5.5% has to be maintained under the common equity tier 1 capital, 1.5% can be maintained under 81 capital, and 2% can be maintained under tier 1 capital. So the bank has to keep 7% in the tier 1 capital, minimum 7% has to be kept in the tier 1 capital, and 2% can be kept in the tier 2 capital. Okay, so here the common equity tier 1, here you can see that the CRAR of the scheduled commercial bank excluding the small finance bank is 16.7%, and the common equity tier 1, that is the most liquid capital of the bank, that comes under tier 1 capital. So common equity tier 1 capital was 14% of the scheduled commercial bank excluding the small finance bank at the end of September 2024. So this is much higher than the requirement, and it provides the cushion against the stress that can come for the banks. Okay, now going forward with the liquidity coverage ratio. Anyone has any idea that what is liquidity coverage ratio? Any idea regarding the liquidity coverage ratio? See, under the Basel Accord, under the Basel requirement, okay, that is the international or global standards we can say. So as per the global standards, as per the Basel Accord, there is liquidity coverage ratio that is having the formula that against the total net cash outflows over the next 30 calendar days. Now let's say that you have deposited the money in the banks. Now many people are depositing the money with the banks. So will you, like, the bank has to return the deposits, yes or no? The bank has to return the deposits, right? So day after day the people are coming to the bank to take back their money. Okay, so many people have deposited their money and the banks have to return the money when the consumers demand. So in the coming 30 days, in the next 30 calendar days, the people will take out their money for their transactions, for transferring the money is being taken out from the banks. Okay, so against this money, let's say 100 rupees is expected to be the cash outflow in the next 30 days. So if the bank is expecting that in the next 30 days the cash outflow is going to be 100 rupees, the 100 rupees will be demanded by the consumers. So against this net cash outflow, the bank should keep some money with themselves, right? So this is the idea, that LCR ratio, it is the value of high quality liquid asset that is kept in form of cash, government securities or gold and such. So LCR ratio says that you have to keep the liquid asset with yourself against the total net cash outflow that can happen in the coming 30 days. So in the coming 30 days, the people will demand their money back. So for that return of the money, you should have some high quality asset with yourself. You should have the enough of the cash and government securities and such with yourself that you can use to repay the money. Okay, so liquidity coverage ratio in our country currently is 128.5. That means if 100 rupees are demanded, or if 100 rupees is the total net cash outflow over the next 30 calendar days, this we are expecting. So out of the 100 rupees that can happen, the cash outflow can happen of the 100 rupees in the coming 30 days. So against that we are keeping 128.5. So we are keeping extra liquidity so that we can return the money. Okay, and so the stress do not come on the banks and there is no liquidity crunch that happens. Okay, so let's say against the 100 crores of the cash outflow that can happen in the coming 30 days, the banking system has 128.5 crores that the banking system can use for the outflow. I hope this is clear that we have high liquidity coverage ratio. Liquidity coverage ratio should be at least 100%. That is, if the outflow is expected 100 rupees, at least 100 rupees you should keep, more than 100 rupees you should keep. So against the 100 rupees we are keeping 128.5 rupees for the outflows. Okay, so liquidity coverage ratio is very good in our country and it is 128.5. So is it clear? Any confusion in the liquidity coverage ratio? So here you can see that the liquidity coverage ratio is good in the public sector banks, private sector banks, foreign banks and such. The liquidity coverage ratio is good in all the banks, in all the banking system. The liquidity coverage ratio is good. Against the outflow of 100 rupees, they are keeping 127, 126, 142, so that the maintenance can happen and the outflow can happen easily. And for all the scheduled commercial bank combined, we can see that the average is 128.5. So this is the liquidity coverage ratio of all the scheduled commercial bank, even including the small finance bank, stands at 128.6 for September 2024. Okay, so this is for all scheduled commercial bank excluding small finance bank. So all the scheduled commercial bank excluding the small finance bank, the liquidity coverage ratio is 128.5, but for the scheduled commercial bank including the small finance bank, the average of the LCR is 128.6. So I hope this is clear that this data of the LCR is for all the scheduled commercial bank excluding the small finance bank. Okay, so all the scheduled commercial bank excluding the small finance bank has the average of the LCR 128.5. Okay, now coming to the PCR. PCR is the provision coverage ratio. So banks keep some additional provisions. Bank keeps some additional provisions against their gross non-performing asset. Okay, so let's say that the gross non-performing asset is 100 rupees. That is, this much rupees is not coming back. So the bank, against the gross non-performing asset, the bank already holds some provision that is of 77 rupees. So 77 rupees of the provisions the bank has. These are the extra provisions that the bank is keeping. The extra provisions that the bank is keeping is 77 rupees and the gross non-performing asset is 100. That is 77% of the gross non-performing asset is covered through the extra provisions of the bank. Okay, so that is also good percentage, that the provisioning coverage ratio is 77% for all the scheduled commercial bank excluding the small finance bank. Coming to the last point, that is slippage percentage. Okay, so now slippage percentage. Slippage denotes the fresh amount of loans that have turned bad in a year. Bad means that the loans that have turned NPA. So the loans that have turned bad, that is the loans that are not coming back, the EMIs are not being paid, the payments are not happening, the money is not getting recovered by the banks, and the borrowers are not returning the money to the banks. Okay, so this is the idea. So slippage denote the fresh amount of the loan that have turned bad, that is not being returned to the lenders, the borrowers are not returning the money. So this is the idea. So the slippage ratio of a bank is calculated as the fresh NPAs, the fresh addition to the NPAs during the year, during this financial year, divided by the total standard asset, standard asset at the beginning of the year. Standard asset means the assets that are standard, whose payments are being made. So slippage ratio is the fresh NPA divided by the total standard asset at the beginning of the year multiplied by 100. So slippage ratio is declining. That means the fresh accretion of NPAs is declining, and it is 1.4% at the end of September 2024 for the scheduled commercial bank excluding small finance bank. Is it clear? All the percentages, are they clear? Because this was the toughest part of the video. So I hope this is clear. If there is any confusion, kindly ask me. So only a few topics are left now. So the soundness of scheduled commercial bank, we can see that gross NPAs are declining, slippage ratio is declining, net NPA is low, return on asset has increased, CRAR has increased, LCR is good, PCR is good. Okay, so you can see that the financial condition or the factors, macroeconomic variables, they are good for the financial system of our country. So there is the soundness of the scheduled commercial banks. This has been bolstered by the strong profitability, declining non-performing asset, profitability is increasing, the NPAs are decreasing, adequate capital held by the banks are keeping good provisions and the good capital, liquidity buffers are also being maintained. So return on asset and the return on equity are at decadal highs. This we have discussed in the report on trend and progress in banking. So I will suggest you that do see that report, because in that report the data is given for ROA and ROE. Okay, so I have taken a session on report on trend and progress. You should see that session also. Okay, so while the gross non-performing asset ratio has fallen to a multi-year low, so gross non-performing asset has decreased, the profitability is increasing, the ROA, ROE, that is return on asset, return on equity is increasing. Now coming to macro stress test. So here in the test there is the change that has happened. So see, by the previous edition what we were doing, or what RBI was doing, that there was the calculation of that was happening of the macro stress test. In this, we were seeing that in the coming financial year or in the next financial year, that is in the coming 1 year, what is going to be the situation of the capital buffers with the bank. So we were seeing the situation in the baseline situation. So we were seeing the baseline situation that in normal conditions, that we are expecting, what is going to be the capital buffers after 1 year. In the medium stress situation, what are going to be the buffers with the bank in the coming 1 year? And in the most severe stress situation, what are going to be the buffers with the bank after 1 year? So this was the macro stress test in which we were taking the hypothetical situation, in which we were taking the assumptions that okay, if normal conditions are there, what is going to be the capital buffers with the bank after 1 year? In case of medium stress situation, some war happens at the international level and some problem happens at the global level. So what is going to be the capital buffers of the banks in India at the medium stress situation after 1 year? What are going to be the capital buffers with the banking system after 1 year if there are some severe stress that is faced by India? Okay, so this was the scenario that was taken. Now from this edition onwards, there are changes that has been done in the macro stress test. Okay, so macro stress tests are performed to assess the resilience of the scheduled commercial banks to unforeseen shock that can come from the macroeconomic environment, from the global environment. Okay, so the framework of the macro stress test, the framework has been revised from this issue of the FSR. So this was the earlier framework that we were following, and now from this FSR onwards, the framework has been changed. So what is the framework? That now we will not take the medium stress situation, now we will not take the severe stress situation. Okay, so we are not going to take the medium stress situation and the severe stress situation. We will also not take the 1 year time period. So the testing framework has been changed. So now under the macro stress test, we will see that what is going to happen in the future, and for this particular issue, the future is considered to be after 1.6 months. So 1 year and 6 months. Okay. So in this particular test, we are going to see the time period that after 1 year 6 months, what is going to be the scenario. Okay, so we are going to see the macro stress test for the baseline scenario, for the baseline situation. So what is going to be the data, what is going to be the capital buffers after 1 year 6 months in the normal situation, that we are expecting. What is going to be the situation with the capital buffers? How many capital buffers the banks will have if there is adverse scenario 1? That is, there are some conditions that are taken, that if there is geopolitical conditions or if there is some problem that comes. Okay, so adverse scenario 1 is taken, that if there is volatility that is coming in the financial market at the global level, or if there is problem at the macroeconomic level at the global level, so how much adverse effect they will create on the capital buffers. And there is another adverse scenario 2 that is taken. So that is how many capital buffers we will have if there is the adverse scenario 2 that happens. So there are different scenarios that are taken, that if this particular problem comes, then what will be the capital buffers? If this particular problem comes, so what will be the capital buffers? Okay, so if you want me to tell you some of the problems that are taken in the adverse scenario 1 and adverse scenario 2. So in adverse scenario 1, the scenario assumes that if there are geopolitical risk and the escalation is happening in the financial market volatility, that is financial market volatility is increasing, then what will be the capital buffers in our country after a year and a half? Okay, so that is adverse scenario 1, where we are thinking about the geopolitical risk, where we are thinking about the financial volatility. In the adverse scenario 2, we are particularly talking about the supply chain disruptions and there is spillover, that if the global growth is reducing, so how it will be spilled over to our country. Okay, so let's understand this better. So the macro stress test attempt, now this is the revised framework. So the macro stress test attempt to project the capital ratios, that is the capital buffer of the bank under a baseline and two adverse macro scenarios. So here we are taking one baseline scenario and two adverse scenarios, adverse scenario 1 and adverse scenario 2. Adverse scenario 1 is talking about the geopolitical risk and the volatility in the financial market. The adverse scenario 2 is talking about the slowdown in the major economies and its spillover effects on the Indian economy. Okay. So here we are taking the baseline situation, that is the normal situation, that is the situation that we are expecting. The adverse scenario 1 is talking about the adverse case, if the risk increases, if the volatility increases, how it will affect the capital buffers of the Indian banking system. In the adverse scenario 2, if the slowdown happens in the global economy, how it will be spilled over to the Indian economy, to the and how it will affect the capital buffers of the Indian banking system. Okay, so we are taking the two adverse macro scenarios over a 1.5 year horizon. So we are taking the 1.5 year horizon. That means we are taking the time period. We are doing this test for the end March 2026. Okay, so we are taking the 1 year and 6 month horizon, incorporating the credit risk, interest rate risk in the banking book and market risk. Okay, so we are doing the macro, or the RBI has done the macro stress test for the baseline situation, for the baseline scenario, for the normal situation, for the adverse scenario 1, where the conditions are taken of the geopolitical risk and the volatility in the financial market, enhanced volatility in the financial market, that if these adverse scenarios happen, then how it will affect the capital buffers of the Indian banking system. Adverse scenario 2 talks about the slowdown at the global level and how it will affect, how the effect will be spilled over to the Indian banking system. Okay, how it will affect the Indian banking system. So there are the two adverse scenarios and the different conditionalities that are taken. So in the baseline situation, you can understand that at the March 2026, the India is expecting, or as per the macro stress test, it is expected, as per the macro stress test, it is expected that in the baseline normal situation, in the Indian banking system is expected to have the capital buffer of 16.5%. That 16.5% of the capital against the risk-weighted assets will be maintained by the Indian banking system at the normal situation. So this is way higher than the 11.5% of the 9% minimum and plus 2.5% of the buffers. Okay, so this is 16.5 is way higher than the 11.5% of the minimum of the CRAR. Now in the case of adverse scenario 1, you can understand that if there are the geopolitical risk that enhances, if the volatility in the financial market enhances, so it is going to affect the capital buffers in a negative manner, and you can understand that the capital buffers can decrease to 14.3%, but still they are going to be remaining higher than the minimum of 11.5%. In the case of adverse scenario 2, that if slowdown happens at the global level, so it will not affect us much, because right now also there was slowdown in the global economy, but our economy was doing fine. So even in the slowdown at the global level and the spillover happens to India, but still we will have good capital buffers of 15.7% against the 11.5, like this is the minimum. Now this test was done on only the 46 scheduled commercial bank. So this test was done on 46 scheduled commercial bank. Okay, so the stress test results reveal that the aggregate CRAR, aggregate capital risk weighted asset ratio of the 46 major scheduled commercial bank may fall from 16.6% in September 2024 to 16.5% by March 2026. But it is way higher than the 11.5% of the minimum CRAR of the RBI under the baseline situation. And it can fall to 15.7% under the adverse scenario 2. No bank would fall short of the minimum capital requirement of 9% under both the scenarios, under the baseline scenario and under the adverse scenario 2. All the banks, that is the 46 banks that are tested on, all these banks under the baseline scenario and the adverse scenario will hold 9% of the CRAR. Okay, so no bank would fall short of the minimum capital requirement of 9% under both these scenarios. But when we come to the adverse scenario 1, that talks about the volatility in the financial market. So however, under the adverse scenario 1, scheduled commercial banks aggregate CRAR may deplete to 14.3% and 4 banks may breach the minimum capital requirement of 9%. So the problem can come when we are tackling the adverse scenario 1, but still only 4 banks are expected to breach the minimum capital requirement of 9%. Okay, so this is the idea. Any confusion here? So there are tests that are done and this is the result. So now non-banking financial companies remain healthy with sizable capital buffers. So the NBFC has good capital buffers. The minimum capital that the NBFCs should have against their risk-weighted asset is 15%. Okay, so the minimum capital, the minimum CRAR requirement for NBFCs are 15%, but the NBFCs are maintaining 26.1% of the CRAR as on September 2024. So you can understand that the NBFCs are also very healthy. Okay, they are maintaining sizable buffers against the minimum requirement of 15%. They are holding the capital of 26.1%. Robust interest margin. Now you can understand that the net interest margin, this is the interest earned minus interest paid. So on the deposits, interest has to be paid, and on the lending, on the loans, interest is earned. So on the loans, the bank are earning the interest, and on the deposits, the bank are paying the interest. Sorry, the NBFCs also. So on the loans that the NBFC is giving, on the loans, the NBFC is earning the interest. On the deposits, the NBFC are paying the interest. So the net interest margin is how much interest earned minus how much interest paid. Let's say interest earned is 100 crores, interest paid is 50 crores. So the net interest margin will be of 50 crores. Okay, so this is the idea that the net interest margin, there is robust interest margins and earnings. The net interest margin is at 5.1%, that is quite high, and the return on asset is at 2.9%. Okay, improving asset quality. The asset quality has also improved. The gross non-performing asset has come down to 3.4% for the NBFCs. So this is the basic idea. Now the same data points are also given in the report on trend and progress in banking. Okay, so the report on trend and progress in banking, this is the part from the report on trend and progress in banking. So here you can see that the GNPA of the NBFCs has declined to 3.4% and the NNPA has declined to 1.1%. So the GNPA has declined to 3.4%, that is FSR is saying the same. So the NBFC data is same in the FSR and report on trend and progress in banking. Okay, the capital buffers are good, GNPA is declining, NNPA is declining, profitability is high. So this is all we want, right? Now coming to the IRDAI's mandate. So the Insurance Regulatory and Development Authority of India, so that is the IRDAI, it manages or it regulates the insurance companies. Now the insurance companies, against the expected liability or against the expected claims that can happen against the insurance companies has to maintain some asset. You can understand that if, let's say, 100 rupees of claims can happen against a particular insurance company, so insurance company must have at least 150 rupees. Okay, so the solvency ratio under the IRDAI, the minimum solvency ratio is 150%. That is, if the claims or the liability of an insurance company is expected at rupees 100, the insurance company should at least have the asset of 150 or more than 150. So against the claims, there are asset that has to be maintained by the insurance company. So against the claims, at least 150% of assets has to be maintained. Okay, that is 150 of the asset has to be maintained. So this is the idea. As per the IRDAI's mandate, in terms of solvency margin, the required value is 150%. That means against the claims or against the liability of 100 rupees for the insurance companies, the insurance companies must maintain the asset of 150. Okay, so solvency margin is the extra capital or asset that the companies must hold over and above the claim amount they are likely to incur. So against the claim amount, there are the asset that the insurance company that has to maintain, and it is 150%. Okay, the consolidated solvency ratio of the insurance sector remains above. So the consolidated or the total solvency ratio is above the minimum requirement of 150%. Okay. Now, if we talk about the CRAR of urban cooperative bank, that has remained robust. The urban cooperative banks are also maintaining good capital buffers in the September 2024, while that of non-banking financial companies is well above the prescribed regulatory requirements. So we have discussed that the NBFCs are maintaining way higher capital than the minimum. So that is good for NBFCs, as it will help the NBFCs handle the distressful kind of situation. Okay. So this is the idea. So now the network analysis. So the last point that we have to discuss today before going to the question is the network analysis. How many of you know that the banks are somehow connected? The NBFCs and the banks. Do you think that they are connected somehow? So do you think that they are connected somehow? Yes, the banks and the NBFCs, they are connected. They are lending to each other also. They are depositing in each other also. Okay. So network analysis indicate that the total outstanding bilateral exposure between the financial institutions are expanding. That means they are getting more and more interconnected, because they are buying the shares of each other, they are depositing in each other, they are lending to each other, they are like having many of the instruments that is transferred between the different NBFCs and banks, and different banks and banks, different NBFCs and NBFCs. So the financial institutions, they are getting interconnected, they are getting more and more interconnected. So financial institutions interconnectedness and the exposure to each other are expanding, especially the scheduled commercial bank, with scheduled commercial bank holding the largest share of the exposures around the financial institutions. Okay, so a stimulated contagion analysis was done. A contagion analysis. Contagion analysis means that if a few banks fall, so how it will affect the other banks. So let's say that I have the most connection with all of you, because you do not know each other, but I can talk to all of you, or I can reply to all of you. So I have the most connectedness with all of you. Okay, Manish, Neil, Nitya, Yashu, Sorish, and all of you that are commenting right now. So I can talk to all of you through the system, but there is less connectedness between you all. Okay, so that is, I am the one that is having the most contagion. If I am doing something wrong, you will also do that thing wrong. If I am providing you a wrong data, you will remember that wrong data, right? So this is the idea, that there is a contagion analysis that was done, that okay, these 5 banks are the most interconnected banks. These 5 banks, let's say 1, 2, 3, 4, 5. So these 5 banks are the most interconnected banks with the financial institutions. So contagion analysis was done to show that losses that happen due to the failure of these 5 banks that have the maximum capacity to cause the contagion would not lead to failure of any additional bank. That means if these 5 banks are failing, so the failure of these 5 banks, even if they are the highest interconnected banks, still the failure of these 5 banks will not lead to failure of any other bank. Okay, so the stimulated contagion analysis shows that losses due to failure of the 5 most connected banks will not cause the contagion, will not lead to failure of any additional bank. So that is good, that even though there is interconnectedness that is increasing between the banking system and the NBFCs and the financial institutions, the interconnectedness is increasing, especially the scheduled commercial bank are getting more and more interconnected, but still the contagion analysis shows that even the top 5 interconnected banks fail, the failure will not spread more. Okay, I hope this is clear. So now coming to the first question, I hope you will be able to answer this question. Okay, and before going forward with the other question, let me just show you that if you go to edutap.in, you can go to the EduTap's website. Here you can see the free material where you can read the blocks for the different examination. Okay, so if you go to the free material, you can go to the block section and you can read the blocks for the different examination. Okay, as well as, and through the blocks you can know more about the exam also. Now if you go to the courses, you can see the courses of the different examination also, where you can know more about the courses, that what they are providing and all. Okay, so here if you go to the blog, so here if you go to the blog, you can see the exam information, job profile and such for the different examination that you want to know about. So you can know about different examination, more and more information you can get. You can also know the strategy and the success story. If you want to know about the courses, you can go to the courses section and you can know about the courses. Okay, now this is the first question. I hope you will be easily able to answer this question. So do attempt this question, do give me the right answer in the comment section. In the comment section, do give me the right answer of this question, and this is the second question. So give me the right answer of this question also. So here, see, the macro stress test is also very important, because in the previous years there has been question from the macro stress test also. So that's why this also becomes important. At least the basic data that is provided in the PPT, at least remember that. Okay, so this is it for today. I hope you like the session. So do give me the right answer of the homework questions. Okay, the question number 1 and 2, and do tell me that if you are liking such report sessions, and do you want me to conduct report sessions in 2 parts, because the reports are usually lengthy, or the 1 part is fine, because I don't want you to get tired and not able to understand. So I hope that you will comment down below and you will tell me that is it fine to conduct the report session in 1 complete session only. Is it fine with you? So this is it for today. Any confusion anyone has? Sorry, it is not compulsory, because for the contagion analysis it is seen that which bank has the most interconnectedness. Okay, so usually the DSIBs, the domestic systemically important banks, are decided on the basis of 4 indicators, and the size has the highest weightage under the 4 indicators, and so the DSIBs are decided on the basis of the 4 indicators in which the size has the highest weightage. But when we are doing the contagion analysis now, in that the highest weightage or the weightage is given to the interconnectedness. Okay, so here in the contagion analysis, maybe the 5 banks are different. This report I have discussed the highlights. There is also the systemic risk survey in the report that I will discuss you in some other session. Okay, now this report in the FSR, its next edition might come in June. So that edition will be more important if it is just coming before the examination. So in this edition, just have the basic idea of the highlights, because the June edition, the June or July edition, most probably it will come in June. So that edition, if it comes near to the examination, this edition will be more important. Okay, so for now, in the current FSR edition, just keep in mind the highlights that the RBI has given, that is given in the newspapers, and the next FSR edition you have to cram it very much. Okay, so right now I will suggest you to focus on the report on trend and progress, because this is a yearly report. This is a yearly report. In the FSR, just do the highlights that I have provided, or that the newspapers have provided, because the next edition of FSR will be released in around June. So the data of that FSR you have to cram. For now, this current FSR is in December. It is released in December. So next FSR will release in June or July. So that FSR will be more important from the cramming perspective. Right now, the FSR, you can see the highlights from the understanding perspective. Okay? So that it becomes easier for you to understand the next FSR that comes near to the examination. Okay, so I hope you like the session, and if you have any query, do write it in the comment section. Okay, if you have any query related to the session, do comment it down in the comment section, and I hope that you are liking the sessions. And if you think that the reports are and should be done in the 1 session, so do comment down below. If you are talking about the finance current affair or the current tab magazine or the report tab magazine, no. The major focus is given to the most important articles or the most important topics. Okay, I hope this is clear. So not all things can be covered from the PDF. that is from the paid PDFs. We cannot cover everything, but I'm covering the most important or the most toughest of the concepts I'm covering in the sessions. Okay. No, Kumar, Roshan, it is not available. Yes, you can get the PDF of the session in the Telegram channel. In the Telegram channel, you can get the PDF of the session. I have told you, competition, that not all topics are covered from the PDF, but the most important ones are covered, and the topics are chosen on the basis of their importance and their difficulty level. Okay. So I hope you are liking the sessions, and do comment down below if you like the session. Thank you very much everyone for joining. Thank you so much for all your wonderful comments, and do comment down below the right answer of the